Hi everybody, Coburn Sheppick here. I hope you're having a fantastic week. In today's video, we're going to be talking about understanding private equity and commercial real estate. So I want to back up for a second and talk about the public markets, which are the most common playing field for investors. And there's a reason for this, and it wasn't up until 2012 till private investment opportunities were available to be solicited to the general public. And this occurred during 2012 again via what's called the Jobs Act, and the Jobs Act made it available for private investment opportunities to be marketed to the general public. Until then, if you weren't in the room via an A+ network or an Ivy League school or an alumni member, you did not have the ability to have the network where these opportunities came from. So it was only friends and families and networks where these opportunities could be presented. So I want to talk about for a minute understanding private equity and real estate. So commercial real estate sits under the private equity umbrella. It's an asset class in the private sector. So private equity is basically the owning of private shares within businesses or real assets like real estate or infrastructure. So private equity is broken into two kind of sectors: leveraged buyouts and venture capital. Leveraged buyouts are basically the purchasing of private shares within more mature companies that might have revenue, might have mismanagement, etc. Venture capital, on the other hand, is investing in earlier stage companies with pretty much an open road of massive growth potential. So it's two types of investments. One is more mature, stabilized, with room for upside, and one is potentially more risk for earlier stage companies that have sort of milestones to hit growth potential. Now, commercial real estate is its own asset class. As you know, people love real estate, and just like any other investment, there's many different types of investment profiles. There's four main kind of groups within commercial real estate. Outside of multifamily, industrial, hospitality, there's four main investment types. And one is core, two is core plus, three is value add, and four is opportunistic. So I want to talk about these four groups for a moment. Starting with core. Core is basically the most stabilized asset you can imagine. So think of a prime industrial site leased to Amazon. This would be a stable tenant, the most creditworthy tenant we could think of, in a long-term lease, low turnovers, highly desired location, newer buildings, etc. Now, moving down the spectrum, which would be core plus, which basically means growth in the investment world. And that would be, think of an older, not too old, still in a great location, but it's just a bit older. It might have older finishes, not as much modern kitchen-like amenities. It might have a black fridge, black stove, wood panel, cabinetry, etc. And so core plus, this means growth. So to an investor, this type of property or asset would basically have the ability to have a capital injection and refurbish, compete with the newer multifamily properties or the core multifamily assets. Moving down the spectrum again, which would be value add, these are unstabilized properties. This is considered to be at more risk as there might not be stabilized cash flow. These assets would need certain key events to occur in order to bring the property up to speed. So it might be a vacant building that needs X, Y, and Z to get released or to be able to have long-term debt, etc. Now, opportunistic is more of ground-up development where there needs even more key events, such as getting the permits, breaking ground, building and getting long-term debt, and getting the property leased up, which would be an opportunistic profile. And these are considered to be at the most risk in the real estate investment world, but offer usually the most upside potential. The key benefit or key reason of allocating to private investments over public markets is the ability to control. And so what do I mean by this? If you were to invest in Bitcoin, or if you were to invest in Tesla from the public market on the stock exchange, you have zero control over who's involved, what their business plan is, and everything else. You're basically just buying and selling shares. That's it. In the private investment world, investors have the ability to have more control. And because people are biased towards certain people or certain markets, certain business plans, etc., this allows for investors to choose the operators who they're investing alongside with, choose the markets that those operators are investing in, choose the business plan, and choose the basis of the investment, which means the price and terms. So you can shop more, you can negotiate more, unlike investing in stocks or crypto, once again, where there's zero level of control besides which sort of investment vehicle you choose. And this is a huge deal because it allows for investors to control the risk and structure the risk away from themselves and their retirement and their wealth. The biggest differentiator aside from control is the level of liquidity. So unlike stocks or bonds or crypto, where this is, aside from cash, the most liquid investment there is, because it's traded on the stock exchange, and so it's traded thousands and thousands of times per day, and therefore people can exchange their assets, their stock holdings or the crypto holdings, for cash without disrupting the market value. Private investments are considered an illiquid investment. The reason for this is because it's not traded on an exchange, and so sellers, whether it's of private businesses or real estate, have to, or even residential, which is a great example, have to go out and seek a buyer, and it's potentially negotiated. And as you know, real estate is priced by the margin. So if one house is traded in the neighborhood for $100,000 less than the others that are comparable properties, that'll move that neighborhood value down potentially, which stocks are not priced that way. Public markets and financial institutions and media have ingrained us with the belief that liquidity is power. So yes, obviously some of us need some liquidity for emergencies, to cover short-term debt liabilities, etc. But we don't need all of our investments to be a liquid investment. We've been trained that liquidity is power. What if you need the money, etc. And the fact is that if you're allocating to an investment, all of us should be playing a long-term game. So the public market is designed, unfortunately designed for financial institutions to earn fees and commissions. And it's because of that, it is the most expensive investment product in today's world. So brokers, this is, I'm not going to name them, but all the big financial institutions you can think of who help open up your brokerage accounts and help you trade and buy and sell are in the fees and commissions based businesses. And so they make money every time you sell an asset. And if you're working with a financial advisor who is driven by volatility and emotions, this can be quite often, and which means investing in the public markets can be very, very expensive, especially for retail investors. Some of the highlights of why people allocate to private investing. I want to talk about one more thing here, and it's about impact and legacy. We all want to leave some impact, whether it's for our immediate family, whether it's for our kids or the next generation, and we all want to have a lifestyle that we can afford. We want to travel. And one thing I want to highlight here is this difference between the feeling of investing in private markets versus public markets. So let me give you an example here. Mark Cuban, who owns the Mavericks, he is out there every single game cheering his team on in his Mavericks t-shirt, in his sneakers, rooting his team on. What I'm getting at here is people who invest in private investments, whether it's real estate, businesses, sports teams are proud and is certainly in alignment with their personality and the impact that they want to leave on people. So to put that into context, you don't see someone walking around, flashing how much holdings they have in Walmart or Amazon or Tesla. It's only for financial reasons to invest in the stock market. And so impact and true legacy is the alignment of interest with personality, what you want to do for the world and the people that are involved, whether it's changing the world, changing the environment, helping the economy. There's more of an alignment of interest outside of financial reasons. So these are the main keys and reasons why private investments are becoming greater for people at all levels. And we'll see this sector of the investment world become more popular. It's already getting way more traction. This new investment world is at our fingertips and is a great way, depending on your investment goals, as far as what type of investment profile that fits your goals, that fits the legacy that you want to leave. There's many reasons to do this. So I hope this gave you some insight on understanding private equity, commercial real estate, some of the benefits and reasons to consider this as a part of your portfolio to create the impact that you are seeking. My name is Coburn Sheppick. I'll talk to you next time.